support. Thirdly, the CFA Institute and its societies contribute towards building market integrity that benefits both investors and members. And it does this through setting global standards, for instance, codes of ethics, asset manager codes, for performance measurement codes, etc., as well as advocating for professional excellence. So advocacy with regulators, with investors, with analysts and journalists within this space. The three strategies highlighted here help to contribute to capital markets together and independently. So speaking back to the topic of discussion today, before I talk about my view of the relevance of capital markets to financial institutions, allow me to maybe deliberate a bit on the drivers for pricing for financial institutions. This is a vanilla model for drivers of pricing for financial institutions, and it includes 5 elements. Different models provide different drivers, but this specific one, available also, by the way, on the internet, looks at the following elements. The first 2 being costs of funding to financial institutions, and this has been split into 2, one being equity and the other being the non-equity instruments, for instance, money market, borrowing, deposits, and managed funds. So the cost of the price at which financial institutions access that money will speak into the lending rate that they set. Secondly is the required return for equity, and there are various equity instruments. It could be outright equity or quasi-equity instruments like subordinated debt, company placement, in the parent company placements, etc. The required return or hurdle rate set by equity participants will also determine the ultimate lending rate that financial institutions charge. Thirdly is operating costs, cost of doing business, you know, the branch network, employing staff, etc., will contribute to the lending rate for financial institutions. And a very interesting one, credit risk. Credit risk will vary based on the different borrowers of the financial institution. So the level of credit risk presented by the different borrowers that approach financial institutions will also contribute towards the lending rate. And the last one is a unique one that does not necessarily sit in all models, but I'll talk about it today, being auxiliary income from the relationship of borrower. So if the borrower presents benefits beyond the lending rate, then that will also speak into the lending rate by financial institutions. Therefore, what is the relevance of the capital markets to financial institutions? Speaking to today's topic, if from capital markets, financial institutions can achieve reduction in the cost of doing business, threefold. One, by accessing long-term funding, whose required return is less than the return that the institutions are currently asked to give to the providers of funding, then this can actually help towards the reduction of lending rates by financial institutions. The third aspect is auxiliary income. Auxiliary income here, I will talk about it briefly in the next slide, would also actually be a benefit that financial institutions could attain from capital markets and perhaps consider reduction in their cost of lending. So like I mentioned earlier, all these speak into reduction in the cost of doing business for financial institutions. As an analyst, I run an independent assessment of this model on a couple of banks in the market. This is public information that is either material or non-material, but everybody can have access to it. So using the model that I shared with you earlier, I try to run the model on information available for 6 banks. I have categorized the banks into listed and not listed to try and drive the discussion so that we can actually see if their cost of lending differs by them listing or not. And I also used some proxies to determine the cost of funding, operating costs, measurement of credit risk using loan loss reserve, and then return on equity requirements around the hurdle rate. So using that model, of course, I will not explain the detail of the computation now. I would like to draw your attention to row 5 and 6. The model returns a lending rate, as you can see under row 5, for the 6 different banks. I also compared that to public information being the current prime lending rates as of January 2020. Row 6, I highlight that there for you to see a comparison. I mean, this could return different results depending on who computes it. So this was my computation, which summary I'm going to provide now in terms of my analysis. I noted that the prime lending rate for all 6 banks, both listed and not, exceeds the model pricing rate. I also noted that operating costs are the highest contributor to the model pricing. Interestingly, there was no variation in the required return or hurdle rate for listed and non-listed financial institutions. So the deliberations coming up will probably speak to that as we talk about how financial institutions can benefit from listing or other capital market instruments. But I also note that where the non-performing ratio, assets ratio, and this is a measure of credit risk, is higher. So for the financial institutions where NPA ratios are higher, non-performing assets ratio are higher, the ultimate prime lending rate for these institutions was higher. So credit risk informs a lot of the lending rate for financial institutions. I also note that where auxiliary income, and the definition of auxiliary income is other income that is not interest income. So where auxiliary income is higher, the ultimate prime lending rate was lower. But also interestingly, both prime lending rate and model pricing reveal mixed signals for the listed and non-listed banks. There's no clear-cut line to distinguish between the benefit of listing and not. And for that matter, as we dig into the discussion this morning, I want to provide some food for thought. This is my final slide. One, it's probably important because I didn't have sufficient time to conduct a trend analysis of the prime lending rate for financial institutions over a full economic cycle to affirm if there is a benefit factor for listing and consider addressing any bottlenecks to enhance the funding cost. The second one is to enforce risk-adjusted pricing across the capital markets and within financial institutions. Because if you do this, then you will see the lending rates for those less risky clients being lower, while those for high-risk clients should be less. And then the auxiliary income I spoke about, where financial institutions can benefit from capital markets. This happens in some markets where capital markets partner with the financial institutions such that the financial institutions conduct the due diligence for any companies that are going to list. And as such, financial institutions can make some income off of that, while the capital markets rely upon the expertise, skills, and experience of the financial institutions. That could speak or inform perhaps reduction in lending rates for any such clients who ultimately list. And definitely, because I mentioned that operating costs represent a high factor into the final moderate lending rate, digitization to try and reduce the cost of physical presence for financial institutions, as well as working under the new normal that does not necessarily advocate for physical presence, can contribute in reduction of operating costs in the medium to long term. So this is just food for thought as the discussion starts. Thank you so much for listening to me. Over to you, Salma.
Thank you very much, Mariam, for helping us set the stage and kickstarting this discussion. For our attendees, please go to the chat or the Q&A section and leave your comments and questions there. We'll have the panelists address them as we close or as we come to the end of the discussion. Our next speaker, as we carry on with our program for the day, our next speaker is the Executive Director of Uganda Bankers Association, His name is Wilbrod Humphreys Owor. Mr. Owor holds an MBA in Strategic Management and a degree in Bachelor of Commerce from Makerere University. Wilbrod has been in the banking sector, rising to the rank of Managing Director, and has over 25 years of working experience spanning across key sectors of the economy, including manufacturing, trade and commerce, international development agency, NGO, as well as consulting and advisory services. He has business development and management experience in financial and consumer services. In financial and consumer services institutions with practical experience in financial management, business development, skills, development, and banking financial products and services. Wilbrod sits on several boards in the areas of FMCG, deposit insurance, investment advisory, and financial services, training, among others. Wilbrod, you're welcome to speak to us. Thank you.
Thank you very much, Salma. Could you enable me share the screen and so that I can present? Okay. Now? All right.
Yes,
I believe
please.
Thank you very much.
Yes, please.
Thank you again for inviting us and joining this particular knowledge session. Look forward to sharing quite a bit. So I'll speak to four aspects. Just touch on the primary function of banks, and then also speak to the pricing perspectives in terms of loan pricing. It's an important topic, and it's important that we share as much as possible. And I'll just complement what Mariam has said. Then I'll go into the substantive issue, the synergies that we can drive between the capital markets and banks, and probably end with some recommendations as we go along. So the banking sector is like any other business who trade in services or commodities. In our case, our commodity is money. And we do this in a framework regulated typically by the central bank in terms of managing risk. I think the important point that I want to put across is that financial institutions, like all other businesses, operate within the environment they are in. So in our case, we operate within the socio-economic environment in Uganda, and that speaks to various things that I'll just talk to shortly. So it's the challenges of that particular economy, the imperfections, the perfections, the GDP size, the socio-economic structures influence or impact on the business, because then you cannot run in isolation of the operating environment. You want to touch on a few factors that inform pricing, and I think Mariam has ably put these across. Just to emphasize that within the overall economy, there are socioeconomic issues that have a bearing in terms of loan pricing. The size of the economy, the complexity itself, are things that have a bearing. Government fiscal policies, and you'll see this when we speak to treasury bill rates and crowding out of the private sector, and how much instead banks are putting into treasury bills as against actual direct lending. The cost of doing business has ably been talked about by Mariam. There are things that not just salaries of staff, but how much time you spend in lands to register mortgages and the issues around them. When a loan goes bad, how much time do you spend in court? Average of 4 or 5 years now, with injunctions and all sorts of things. There's a new one now where people go to the Constitutional Court to appeal interpretation of something. All of it just to delay the recovery processes. Obviously, banking sector has plenty of regulation, highly regulated sector with performance benchmarks. Some of them have a huge bearing in terms of the cost of regulatory compliance. and also the level of sophistication of the actual financial sector. You will see in the subsequent slides as I speak to the structure of a particular banking market and the dynamics that are driving those things. So from an external point of view, those things ultimately inform pricing, but also there are internal things that Mariam has ably talked about. One of them is the bank size itself and the makeup of the balance sheet or the cost structure. When, for example, financial institutions mobilize deposits and the bulk of their deposits are made up of fixed deposits, they have a huge challenge in terms of pricing because then they have to pay for those deposits. Cost structures, and this speaks to efficiency. You find that they have huge running costs. You will see most of the cost to income ratios of banks is above 68, some of them going to 88% before you put in tax, before you put in non-performing loan provisions. The credit risk appetite is very ably spoken to by Mariam. Again, there are sectors that are clearly high risk. There are sectors that are more less of risk. The customer segment matters. There is one of our banks that has 0 NPL, and every single loan is performing. And that informs their pricing. They are pricing at most transactions at 14%, while others are above the 20 mark. So those things tell you the factors that go into them. The TB rates have a very important role they play. You'll see in the computation of pricing, and obviously the return on assets that the shareholders may be looking for. So just to repeat what Mariam showed us, which really brings out most of the things that we've talked about, you see the things that go into computing lending rates. And for us, as before I conclude, you'll see later that for us, the treasury bill rates mean a lot more than the central bank rate, the CBR. But the risk issues that she talked about, the credit risk issues, right now it is 5.8 at an industry level. But depending on the bank, one may have 0%, another may have as high as 9%, depending on the sector they lend to and the rest of the other things. So you see how it falls into play, and anywhere in there, depending on the framework of the bank, the efficiency, the risk appetite level, pricing could then differ across the board. There are a lot more insights. As I was saying, that the industry has an average cost income ratio of 68. Banks depend a lot on interest income. Most of them, I think Mariam's called the other part ancillary income, but the rest of the income up to 68% for the average, but up to 88% for many of the banks, depend on loan interest income to survive. And then you will see that in their balance sheets, nearly a third of the deposits, which should ideally be lendable for extension of credit or expansion of credit, is invested in treasury bills because the returns are good there. There is literally zero risk, and that crowds out private sector borrowing for credit. It may also be of interest to you, and this is where the capital markets, really, a well-functioning capital market is important, that 11 out of the 24 banks of the total capital deployed, that is 88%, comes from just 11 banks, meaning out of the other 24, another 13 are looking for capital. And well-functioning capital markets, like Mariam said, would provide the long-term finance that enables the intermediation role of the banks. Just to give you another scenario, talking about social macroeconomic factors, our total loan book, private sector credit, is 16 trillion. The case in Kenya is 99 trillion. So that's about 6 times what we lend here. And those things have a bearing because the credit is huge across and banks are liquid, well-capitalized through well-functioning capital markets. It has a bearing ultimately because of economies of scale in terms of the pricing. You will see again that 12 out of the 24 banks account for 13%. In other words, the other 12 take the 87%. So again, a well-functioning market, capital market would provide a lot of capital to those banks that need it to then deploy it as appropriate. And it would obviously apply in the same way for the loan book. So those are important things to take into account. Now, I was asked to speak a little bit about what the industry is doing, especially in these tough times of COVID, but also some of the efficiency measures within the banks, because as you can see, both external factors and the internal factors within the financial institutions and market efficiency. We are working with the Bank of Uganda around reforms across the industry. We're also taking several collaboration projects across the industry to address issues of cost, largely through shared platforms, digital platforms, championing dispute resolution. Really, this is to deal with the case backlog and challenges in court, and ways of handling the non-performing loans through the asset reconstruction company, so that both the businesses that struggle and for which prudential regulations require us to work through them within a year or less can be attended to in a much longer way. We're also pushing digital channels and engaging government on the other fiscal aspects as well. And this discussion today is important for us because then we have a full appreciation of the role of capital markets. In terms of the direct credit relief measures during this particular post-COVID or current COVID period, we are doing a lot of restructuring. Nearly 99% of all the applications that come through, we are either giving payment moratoriums or restructuring the payment flow or the cycle, just to give relief to customers in the process of recovery. You can see the various numbers across in April, May, and June. April and May had huge numbers, and now you are beginning to see that in June, the volumes are going down, but the value is still big, meaning it is now the big ones we are beginning to deal with. Initially, we were dealing with a lot of SME, personal borrowers. Now it is the bigger ones. And sectors like education, schools are heavily borrowed, huge amounts, hotels. We are beginning to get into the complex space of dealing with the bigger ones. So really, numerous synergies really exist. And capital markets would complement banks as major players in the financial market by the expansion of financing capabilities, provide the necessary credit or liquidity and capital, patient capital that banks would need. You saw in the other slides, the 14 or so banks that really need a lot more capital to deploy. So financial markets would also diversify sources of finance and risk, because then the combinations that you provide to financial institutions and even to businesses themselves could be debt, could be equity, could be a combination of that, could be other guarantees. We have issues around mismatches, where somebody wants to borrow for a much longer time, but we can't lend because we're using short-term money, customers' money, and things like that. Those things are important because they deal with tenure of the loan as well as the pricing. So definitely a well-developed capital markets would really cushion interest rates heavily, would provide the necessary long-term patient capital, and obviously the appropriate combination of the financing modalities that we badly need, and therefore progressing the growth of capital markets is critical for any country. And how does a country do this? Obviously, the most important thing is ensuring that the operating environment is very attractive to both big and small players. And the yield here is very important. And the fiscal policies that attract such investors and other long-term providers of equity capital. In Uganda now, until recently, we're charging withholding tax on long-term bonds of up to 20%. In Kenya, in Tanzania, this is zero rated. So if you are an investor seated in London, where would you put your money? You would obviously take it to Kenya, where it is zero rated, because otherwise whatever income you earn then would have been taxed at 20% withholding tax. This has been revised for those 10 years and above to 10% now, but it's just to give you the operating environment of how attractive it is. Consistency in the policy direction so that investment destination. An investor knows that, yes, these are the policies, things won't change overnight, obviously supported by banks. The regulation, the dispute, how long we resolve disputes, very, very important. So an investor knows if there's a problem, it won't take me for 8 years to sort out an issue as they arise. Even how attractive and good the deals are. Most of the deals, again, we spend time in investment advisory. Many businesses are small, they are family owned, there are governance issues, they may not wish to open up for others to take equity. That can constrain the development of a market because then perhaps there are no big deals. Or the country itself may not have big attractive deals. So things like the development of the oil and gas sector are important aspects for the country because there will be large attractive transactions and there can be numerous players across the value chain, not just petroleum, but the petroleum supported industries like pharmaceuticals, plastics, large things that can happen, logistics and things like that. So these are things that are important from a policy perspective to deal with. Lastly, how would we then recommend the way forward? Obviously, to reinforce what I've just said, commitment in addressing the macroeconomic issues and ensuring the operating environment is favorable and consistency is seen. For the central bank and other policymakers, from what I described, for us, we think that the CBR as a monetary policy transmission tool may not be as effective. I think the TBR, you can see the treasury bill rates are more meaningful to us. I think CBR does more of inflation management and targeting. We also focus on, I think we should focus on strategies that enhance competition across the market. That is very, very important, but also the enablement, even for the smaller players, to get some part of the market share and do business well. I can't overemphasize the need for working on credit risk, very, very important, because if you lend and 10% or 12% of it goes bad, you are discouraged at doing that. And then for us in the industry, we can't run away from this. Even the banks themselves, we need to work on internal efficiencies, address issues like cost-income ratio that, as Miriam said, have a bearing ultimately to loan pricing. So I just thought I could share those. And Salma, once again, I want to thank you very much for giving us this opportunity. Thank you very much.
Thank you very much, Wilbert, for giving us that great insight into a few of your thoughts. I'd like to carry on with the discussion and invite the next speaker, Mr. Simon Ortega, to give us a few thoughts on the topic. Simon?
Thank you very much.
May I put up your presentation?
Yeah, please do that, please. Thank you very much. It is, again, my pleasure to be part of this panel discussion this morning, I think on a very relevant topic. I'm going to speak, I think, in terms of the Financial Markets Development Committee, which is a committee that is supported by the central bank. It is a committee of key stakeholders in the financial system. And the goal of this committee is to ensure that the financial sector in Uganda is progressive and competitive and is anchored on stability and inclusiveness. What I want to talk about, I think most of the talk here has been about commercial banks, but I want to say that the point of a disjointed strategy to financial markets ecosystem development, I think, has been the challenge in our market. And my presentation is just going to be on this slide. We're coming from a silo strategy where each of the important players in the financial system tried to make their point, whereas I think what we are trying to do is work in a coordinated and holistic ecosystem, because capital markets is complementary to housing, it's complementary to private equity, it's complementary to commercial banking, retirement benefit insurance, and development finance. So what I want to talk about here is some of the things that we are trying to do that will impact the cost of credit, because we're in the business of credit extension, and credit has a cost. I mean, if it is a business, credit must have a cost. Now, we try to impact here by conducting independent assessments on each of these clusters, including the government policy, regulations, and each of the clusters, on how we can improve the clusters and have a more competitive sector that complements each other. So government policy has been talked about. I think that's important. Regulation has been talked about. We have impacted regulation in the market so far in the last 3 years since we were in business. We now have a National Payments System Act. We're going to look at regulation on digital financial services. We're going to look at regulation on housing, etc. The policy, of course, fiscal and monetary are important. And I think for capital markets, the fact that the country moved, like most countries, into an inflation targeting anchor mode is and plays into the capital market investment bankers realm, because we're now, I think the country is targeting an inflation rate. The central bank is transparent. It communicates inflation expectations. But I think most importantly for the capital markets is that as opposed to the past, where they were targeting money or cash as the anchor, which is a liability issue for the central bank balance sheet, everything around this inflation targeting is on the asset side. So it's treasury bills, it's treasury bonds, it's reserves, and that plays into the capital markets industry. And I think it's something we should take advantage of. The signals that the central bank gives are official signals, but of course, as investment bankers, we have our own signals and we compare them to what the official signals are. And of course, that impacts our cost of funding. Let me talk about some of the initiatives that are important in reducing the costs. One is shared financial infrastructure. I think that is very important. As we move towards a digital financial services environment, I believe that will bring down the costs of credit. The National Payments Act has been passed. I think that's going to impact delivery of digital financial services. Fintech is here. The national switch. So I think as a sector, we have to look at shared financial services, and especially moving towards a cash-light society. Because I think once we move towards a cash-light society, the transaction costs both for the issuer, which is the central bank, goes down, and that of the users goes down. Now, as you look at this circle on the right, I just want to point out a few things that will impact capital markets and some of the initiatives that we're taking. For example, housing, we're going to come up with a mortgage, or coming up with a mortgage refinance company. Regulations are now being considered by the central bank. What that does, for example, is it creates an institution which is going to provide wholesale financing to mortgage providers. So for example, today you'll find that you have predominantly one bank, Housing Finance Bank, which probably has about 55 to 60% of the market. What this institution does is it then provides this wholesale funding to more distribution channels, to provide them to more banks, more circles, and you have wholesale capital going into developing the housing sector. So that's an initiative. Now, for the capital markets, that institution can then go to the capital markets to raise funds. So you have an additional client and you have more competition. Another example is development finance. We now have at least one development bank where capital has been increased from $80 million to $500 million, which is probably about 9 small banks. Now, what that does is then with that capital, the focus, first of all, is long-term financing. it's cheaper capital. And there's also a relationship now with commercial banks, where commercial banks will work with the development bank in terms of having the same clients who are obtaining long-term capital from the development finance institution and obtaining working capital from commercial banks. So that complements each other. And then you have a development bank, again, which is well capitalized, which can then come to the capital markets and issue bonds. So I'm trying to show you this coordinated and holistic ecosystem that is critical to bring down the cost of credit in this market. Let's talk about credit scoring, for example. There are initiatives now going on to create a unique identification, which is a national identity card, so that you have that input into credit scoring for the population. We're also trying to move from a system of reports to scoring, so that each individual has a score. And therefore, what that means is that if you go to a commercial bank for a consumer loan and your credit score is excellent, I am sure you will not borrow money at 25 or 28%. So that information asymmetry issue also plays into the cost of commercial banking. One of the other things that I think I want to mention is that for commercial banks, the point was brought up that why aren't they coming to the capital markets to raise money, especially for their core capital, as is done in other jurisdictions? And I think this is a conversation that we have to have with the commercial banks, and whether it is the cost of capital in the capital markets today or other constraints, so that again, you have this complementary relationship that is taking place. The cost of regulation, I think, is quite important. On my own personal view, if you look at the cost of regulating small banks, they're high both for the user, for those banks, and they're also high for the regulator. So I think a conversation here has to take place on increasing capital. So perhaps we have consolidation and fewer commercial banks, which are well capitalized. And I think now with the argument that you have technology, the issue of niche banking doesn't have an argument as it used to have before. So I'm seeing a space where you have higher well-capitalized banks, fewer, also reducing the cost of regulation for both the banks and for the regulator. So what I'm trying to point out here is this synergy, is this coordinated and holistic ecosystem that plays into reducing the costs of credit in our market. So I want to also move on to the private equity space, the types of capital that we have. I think we have to understand that we need to diversify our capital sources. And the capital sources, you have risk capital, you have venture capital, which right now is being provided mainly by impact investors. But having said that, there's quite a lot of capital trying to be deployed in the market. Again, here, some of the issues I've seen in the experience is the people, the quality of our business people. So sometimes the argument that there's lack of capital comes into play, but sometimes it is very difficult to deploy this capital. So I think our people have to up the game. Sometimes you look at balance sheets where they are seeking capital. The first year, they seem to be doing well. The second year or third year, things don't seem to be working. And then when they are seeking capital, the projections shoot through the roof. And you ask, what has happened here? So I think, again, our business culture, our promoters, we need to have that conversation that you have to be patient, but you also have to be transparent and accountable. So my presentation here is short. I am optimistic. Quite a few things are taking place. As a committee, we're working with stakeholders. There have been a whole number of reforms going on. And we're going to continuously undertake reforms, whether it's credit information, whether it's quick justice, whether it's automation of transfers. I think the whole point here is to create an environment where you reduce transaction costs as much as possible, and you create a framework that can complement each other, so that commercial banks are going to the capital markets to raise money, and development finance is supporting commercial banks. So you have a coordinated and holistic financial system. Thank you very much.
Thank you very much, Simon, for those great insights. To our audience, please use the Q&A section to ask any of our panelists questions following their presentations. We'll have a session to cover that. Thank you very much, Simon, once again.
Thank you.
I'd like to move on to our next speaker in the investment banking and the transaction advisory space. We have Mr. Robert Baldwin. Robert is the Chief Executive Officer at Crested Capital. He has developed and managed award-winning teams in East Africa for over 20 years. He's an entrepreneur and advises boards of both public and private companies on strategy, financial structuring, and corporate governance. Excuse me. Robert, please, you're welcome to speak to us. Thank you. Robert, sorry, you are still muted. I'm going to unmute you.
I had such a great introduction. Sorry, let me do it again. First, thank you to the USDE and the CFA Society and the Uganda Bankers Association. And I don't know, Simon, if FMDC is part of this, supporting the organization here, today's event. But it's great to be here, wherever here is, relatively speaking, with the other 68 participants. I've got a presentation that's a little bit brief, though some of the items are covered. This is what happens when you go last. Let me try and share my screen. Is that visible? I'm screen sharing here. Somebody see that? Someone?
That has come on now.
It's come through. Sorry, when I share screen, I lose my zoom. It's not something I've done before. Is it visible?
Yes, Robert, it is.
Thank you, Paul. Thank you all. Sorry about that. So look, the other panelists have talked a little bit more focused on lending rates, and I'm coming from a perspective of the market and really trying to marry the two concepts of what banks are achieving here, and they're very important to our capital markets, and at the same time, how is the market relevant to the banks? And so my first slide talks about the perspective of how the stock market sees the banks. We have 9 listed companies, and the banks are the largest represented, not including, of course, the cross-listed. We have 3 listed banks out of 9, so 33%. But it's just another business as far as the stock market is concerned, and so on. The banks may see the stock market as just another competitor. Banks are looking to deploy these funds at different levels, different types of credit risk. But if the funds go to the market, then those funds are not available for loans. The public, and that's I think why we have this seminar today, the public sees banks sometimes, and maybe this is just my personal view, as a necessary evil. I know the Bankers Association, we don't have a panel where you can't throw things at me for saying that. But banks are necessary, certainly. And the public sees that banks' interest rates are too high. That's how they may see it. The stock market, going to the next, sees that banks could take away deals that could go on the stock market. For example, I believe there was some funding done for some medium-term financing that was done through a bond on the stock market, but part of that was done through a syndicated loan. Now, there are reasons for that, and that's perfectly viable, but the question is, do we have to be competing? So for the banks, they see the stock market as taking away deposits, potentially. For the public, they look at the stock market and say, what is the stock market? The Ugandan stock market is not very well known. It's a challenge that we have to make ourselves relevant to the public. They don't see good investment options. There are headlines that show challenges to the current listed companies. So they see that those aren't good investment options. So what does the public want? The public wants low-cost loans, and they want high returns on investment. They want it all, as they always do. So how can we do this? Well, finding cheaper capital for banks can involve getting more of them listed. So let's look at, and I think that I think Mariam had looked at some of the key ratios. So we also looked at some of the key ratios for the listed banks. And we find that the listed banks perform quite well when it comes to payouts. So they're paying out in the 40% of their net earnings back to shareholders, which is great. Their net interest margins also lower. Okay, so they're lower than the sector as a whole. The cost of financing is a little bit higher, but we'll go into the specific reasons for that. A little bit higher than the sector, but here's your average for your sector the last 3 years. One of the big ones that stands out to me is about operating costs, and this was mentioned again by Miriam, I think, and Wilbert. Operating costs for listed banks are significantly lower. They're in the 50s compared to the 70s for the average sector. Return on assets is reasonably close, and the return on equity is much higher for the listed banks. So we have the numbers here, and as an investment banker, investors really just want to see these returns. Now, obviously it's compared to the sector, but let's look at more specific listed bank performance. Now, there are also cross-listed banks, KCB and Equity, but I focused on the 3 Ugandan banks which are listed. So those are Baroda, DFCU, and Stanbic Bank. Now, to compare to each other, rather than as a sector, you can see that the margins for these banks, the NIMs, are pretty reasonably average, between 6 and 9%. Okay, so that's a pretty interesting margin, up at 9% for Stanbic. The cost of financing here varies a lot. So you see that Baroda has expensive financing compared to, also similar to DFCU. If we recall, DFCU had a rights issue, but Stanbic has found a way as a listed bank to get its cost of financing very, very low. Here from the cost to income, you see that we're in the 40s and 50s, a little bit higher for DFCU Bank, but 50s really on average. And your return on equity per bank ranges really from 16 to the mid 20s for Stanbic Bank. So from an investor standpoint, the performance of the listed banks is very good. They do vary between each other, and they do have some variance over each year. You have some changes here. There were some activities happening, but ultimately, we need to ask the question: is performance enough? So listing can give you other benefits. We talked about transparency. Transparency of costs, when you look at your cost to income, are much lower compared to the industry. So where are those costs? Where are those operating costs going? We heard about legal fees. We heard about it's very hard to collect from defaulters. But is this something like state capture? We talk about state capture. What about management capture of the costs of doing business? That the high costs in the 70s is really far too high. Where if you look at the listed companies, they perform better in the 50s and maybe some of the 60s because they have the scrutiny of producing their annual reports. They're publishing their financials in much more detail. Obviously, all commercial banks are publishing their financials, but not in the same level of detail. So we think that makes a very big difference. So what do we do? So if we agree that listed banks have better performance, what should we do next? So it's a proposal to say that, and reforms were something discussed. Simon, you're talking about reforms. One of them could be to require all licensed tier 1 commercial banks to be listed on the Uganda Stock Exchange. There can also be reforms needed to the stock exchange itself, because the stock exchange has operated for a number of years with the impression that it's a limited group of people who are managing that and so on. So I think the first reform is to ensure that there are independent non-executive directors who are part of the board of the stock exchange, and this process has been ongoing, I think, very well. That's ongoing and continuing. I think there's a question to be asked that banks who are brokerage firms, why are they allowed to trade in their own shares? You know, I think that's a valid question. And finally, banks and brokerage firms should not be the only owners of the stock exchange. The stock exchange itself should look at the idea of greater transparency and kind of practice what we're preaching in terms of opening up to other investors to be able to do a better job of executing its operations. So I'm sorry for the short but sweet presentation, but I think maybe hopefully we can generate some questions from this. So thank you to the USE for putting this together today.
Robert?
Yes. So I'm done, Salma.
Thank you very much. Thank you, Robert. I know we are almost fast spent on our time, but I'd like to just quickly invite our CEO of the Uganda Securities Exchange to just go through his, to give us a few words, and before we can take on any questions and comments from the audience. Paul?
Thank you, Salma. And I'd like to thank the CFA Association, the Uganda Bankers Association, Simon and FMDC at the Central Bank, and Crested Capital for participating in this webinar and this discussion. I'll ask Salma, are you going to put up the presentation?
Yes, I am. Just give me a few seconds. Paul, please proceed.
Yes, so my presentation is really brief, and as we go through it, if we could move to the next screen, it's really to look at the history, what kind of investors have been in the bond market, what banks and listed banks have raised on the exchange, and how we can actually diversify our products at the exchange to facilitate lending at a lower rate within the industry. So briefly, when we look back, the first issuance on the market was the East African Development Bank bond in 1999, where EADB raised 10 billion with a 4-year tenor and at a rate of 182 plus 200 basis points. So they were using the 182-day bill as the basis. Fast forward to date, and what was issued, or the bond sizes were about 331 billion that were to be raised, and out of that 288 billion was actually raised. We've seen that other than Uganda Telecom and MTN that raised money in 2001, all other issuances were through banks. From PTA Bank to Housing Finance Bank to Standard Chartered Bank to African Development Bank. We've seen that Stanbic Bank, among others, we've seen that the issuers of bonds on the exchange were banks. And then, of course, in 2014, we saw Kakira Sugar Works issue a bond of 75 billion at a fixed rate of 14 0.67%. So the trend has been that for this market to be active, and the supporters of this market who've been raising capital have actually been the banking industry. And as that trend changed, one of the things is that we're trying to analyze what changed and why are banks not issuing or raising capital for their clients. In terms of tenor, the tenor ranged from 4 years to 10 years, depending on each issuer. The last 3-4 bonds have been in the range of 10 years, but prior to that, we saw the MTNs and Uganda Telecoms raise for about 4 to 5 years. So the bond market actually provides the flexibility for the short end to the medium to the long term in terms of the requirements of an issuer. To date, through equity, the exchange has raised 1.9 trillion for the 9 listed companies. That includes both rights issues and bonus issues, but also the secondary offers that have been on the market by Umeme. In terms of the debt, I already mentioned that about 288 billion has been raised to date through these different issuances on the market. That's a bit of background in terms of the issuances on the market. In terms of rates were quite low, from the range of around 12.6. I think the highest we saw was about 15, but the floating rate, the 182-day, meant that it was a floating rate bond, and those floating rate bonds meant that depending on where interest rates were and the CBR, that drove the cost of capital for the issuances. And I think the average rate we saw was around 12-13%. This probably would go lower if this was the same, if the same assumptions were kept, if issuances were raised at this point. The lowest basis points were 150, and the highest was about 200 basis points of the 162-day bill rate. Salma, let's move to the next slide. So this really shows the history, and specifically what we focus on are the financial institutions. And 700 billion through debt and equity has been raised over the last 20 years. You must note that these are only 3 institutions in terms of equity, and in terms of the corporate bond, there are about five companies that were able to raise money, or institutions that were able to raise money on the market. What we want to do, and really why we're having this discussion, is really what does the future hold? We need to look outside the box. Salma, we could move to the next slide. Understanding the needs of the issuers, the financial institutions, but also looking at corporates. Corporates specifically that need to either refinance their debt that they're having challenges with, but also the ability to raise money off this market. I think Simon raised a very important issue, is that many companies are not ready or are not well prepared in terms of their bookkeeping, in terms of their mindset, in terms of their business models, to be able to raise money. And hence why banks have been able to refinance their loan book by issuing bonds on the market to specifically finance certain types of businesses that on their own cannot come and raise money to meet the requirements, but the listed banks or the banks are able to, because they've got the capacity and they've got all the enabling requirements to raise money. So this discussion we've had from the different panelists, and we picked up a couple of views. And one of the things we'd like to get out of this is to share new ways of enabling businesses to raise money off the market. We've had a few discussions with some banks that want to issue medium-term notes, and what that ensures is that they issue a bond once or a note once, and are able to come to the market and continuously raise capital for the different companies that need to finance further into the medium to long term, and not necessarily tie down their short-term capital to lend to these companies, but also to encourage the large companies out there to look at this market as an option. And as we get the views out of this, we will be approaching them and showcasing how they can actually tap into this market. That is it from me briefly. Didn't really want to stretch the timelines. If we could move to the last slide. This really looks at where we are and in terms of the investors that we've got on the market. As you're all aware, we launched our electronic account opening portal, where investors can now open accounts online. And the trend shows what you see on screen are the different kinds of investors we've got from the local companies. Of course, the majority are the local investors. But in terms of participation, the foreign companies are the largest. As you'll see from 2015, 81% of the turnover came from foreign companies. This trend has reduced this year because of the impact of COVID-19 on the performance of the market. But if you look at our local investors, that is where we've got a lot of work to do. That despite the challenges in the market, we've not been able to grow that number. As you can see, the average has dropped significantly down from 7.5% to 2.7%. That's at the extreme left of the slide. The East African investors have also come into the market. They've seen the opportunities in the market and they're starting to participate during this year and over the last 2 years. But generally, there's a lot of work we've got to do. Technology is one of the areas we are investing in. And also in that investment is in terms of making it easy for companies to raise money by using technology, not necessarily going through the old ways of doing business and having large prospectuses, large documentation. This is a discussion we're having with the Capital Markets Authority to ensure that we can come up with a simplified way of matching bringing investors closer to the companies that need to raise capital and reducing that timeline within which companies can actually raise capital. The other reason we are holding this kind of webinars is to actually educate the different sectors in what the capital markets and the exchange is able to provide. And by doing that, we'll enable them to address the issues that they might not be able the issues they're not able to address in terms of requirements, but also simplify. And as we discuss with them, we'll know how to improve the issuances, but also understand what their specific needs are, and we can actually customize some of these issuances to them. Finally, I think one area we've not spoken about that has a lot of potential is the commercial paper, the new regulations that came out from the Capital Markets Authority. And we think there's a lot of potential in that short-term lending for the larger institutions that can mitigate and short-term challenges, but also roll into the medium-term and long-term. And again, this is an area that we need to look into and develop. With that, I'd like to say thank you to the USC team that has organized this, but also thank once again the CFA Society, Will Broad and your team at Uganda Bankers Association, Simon from the Central Bank, and Robert from Crested Capital. Thank you for honoring our invitation and participating in this webinar. Thank you. Over to you, Salma.
Thank you very much, Paul. Thank you very much to all of our panelists. I just like to give a few minutes, maybe about 5 minutes, to some members of our audience. You have the option to also raise your hand in case you would like to speak up or ask our panelists a question or provide some particular insights and views on our discussion today. As I look out for anyone who may have raised their hand, we did have a few questions coming through the Q&A portion of our webinar. I noted a couple. Isaac Kisa wanted a comment from Wilbrod on why he thinks banks are reluctant to raise funds from the capital markets. Wilbrod, let's start off with you, giving a comment on that. Thank you.
Thank you very much. Thank you very much. They are private sector players. For me, what may be obvious is that perhaps raising money at 14.67, I think that was one of the rates he mentioned. Anyway, anywhere between 12 and 15 would already raise the cost of funding. And then when you put in all the other things that we indicated in terms of other operating costs, provision for other non-performance, perhaps banks find that it may be an expensive route. That said, like I said and emphasized, I think the role of the capital market is very, very important. So I think while I think Robert said, on the one hand, you want to make it attractive to investors. On the other hand, the borrowers want it at a cheap cost. So they want everything. I think if we can work through that detail and get the right balance, it should ultimately become more attractive for banks to then come to the capital markets.
Okay, thank you, Wilbrod. Hilary Asimwe, your hand is raised, and now you have the permission to speak.
Yes.
Please proceed, Hilary. Thank you.
Thank you so much, Salma, and that team that put this together. My name is Hilary Asimwe. I am also I also work in this market, I should say. Now, some of these things have really been said. Thank you, Mr. Baldwin, for the insights, for showing us clearly that the listed companies are actually, performing better than the whole industry, the banking industry in particular. Now, we are really talking about the role of the capital markets vis-a-vis the lending rates, like he said. But my worry, what I would recommend really is we need to show the authorities or whoever is really concerned. I don't know if it's Bank of Uganda or Ministry of Finance. We need to look at, the capital markets driven economies and how they're performing. Then we show it to these guys and tell them, here is what we shall get if we champion capital markets instead of allowing companies to raise finance entirely through the banks. Things to do with employment, because if you look at the capital markets driven economies, of course they are really so much developed, but there is always a first time for everything. They started somewhere. So if we can translate that to our people, the government, for the support and all that, maybe we shall get somewhere. Because if you look at the finance that is raised through the capital markets in other countries, I mean, it's way bigger. It's way bigger than the finance that is actually raised through the banks. So the stock market can actually do better than the banks in terms of raising finance, in terms of developing the economy generally. So that is where I call upon the capital markets, authority, the stock exchange, the players to do the research and read these guys in so that they can actually support us with concrete evidence, really. And I'm very sure these guys are actually doing this, but honestly, I've not seen it. I've not seen any reports. I've not seen any research papers. So I really don't know. Thank you so much, Salma.
Hilary, thank you so much. I think it was a comment, and also maybe Paul can enlighten us on whether any work is being done in terms of addressing and making sure that the right people have the information needed to further raise or increase the number of companies or the number of banks that can raise capital on the stock market. Christopher Nantaja, your hand is up and you may speak now.
Hello, can you hear me?
Yes, Christopher,
yes.
Please proceed.
Yes, mine. I've posted a couple of my questions already in the Q&A session, but I'll just repeat them here as well. But first, I would like to speak to what the current speaker just said. I think it's a fallacy if we think that we can raise cheaper funds from the capital markets versus the banking sector. I think then we're not critically looking at how the banks actually come up with the lending rates. The lending rates, the first basis of the lending rate is a risk-free rate. So it doesn't matter whether you go to the capital markets or to the banking sector, you will still have the risk-free rate to deal with. So if the risk-free rate remains at 14%, what makes you think you're going to raise money in the capital markets at 13 or at 12? It won't happen because it's the same build-up. It's the risk-free rate plus the operational cost plus the risk premium. And then you get to the same level. So as long as the risk-free rate remains high, it doesn't matter where you go, whether the capital markets, whether money lenders, or the banking sector, the cost of capital will still be high. Which takes me to the questions that I had proposed. One, we say high lending rates, but we haven't explained high relative to what. Is it high relative to money lenders? Is it high relative to the region? If it's high relative to the region, then have we looked at actually the risk-free rate in the region? So relativity is very important for us to pin it on high. When actually looking at markets like Ghana, we might be low. Okay. The next question that I would have, we talk about them as high lending rates, but the CBR has moved 200 basis points. I have not had the speakers address the CBR has moved 200 basis points, but the risk-free rate, the 1-year T-bill, has moved 0. If at all, it has actually inched up from the time the CBR moved. So how do we then expect these lending rates to actually move? The CBR it's just a figure put out. You can't expect banks to move while the government continues to borrow higher and higher. And third and lastly is that even if the CBR cuts what will point to lower banking rates, can we address the pricing of risk in the banking sector? We've just seen NPLs for KCB have actually gone up 40%. So if we expect the banks to follow the CBR, this is a risk-free rate. If we look at the build-up of the lending rate, it's a risk premium, operational costs plus the risk-free rate. The risk premiums of these people have gone up. We don't know how many companies will actually be alive post this pandemic. We don't know how many people will have a job. So how does the bank then lower risk premium on debt that has actually increased in risk? People are not paying. Repayment holidays have been offered, and we expect risk premiums to move the opposite direction. So I think there's a lot that needs to be considered. It's not just lower rates because the CBR has moved. No, it's actually look at the pandemic as well. The risk to the banks has actually increased. So if at all, they should actually take them higher. That's my contribution. Thank you.
Thank you, Christopher. Tabazi Geoffrey, please give us your insights or question.
Hello, everyone. So my name is Mutabazi Geoffrey. I run a startup called ChargeCo Technologies, and I'm really thinking about more like the startup community. Uganda is the most entrepreneurial country in the world, and I think this speaks to the number of businesses we have starting and the high number of the high percentage of youths in the country. So with all this innovation and all these small businesses starting, where are they going to grow from? So you've seen growth as a very huge problem in terms of how do these businesses scale? How do they expand into new markets? And my plea here is is that before we look at Silicon Valley models of growing our entrepreneurship ecosystem, we should look at when you're talking to any investor, they're asking you exit. Am I going to exit through a stock market, an IPO? Am I going to exit through an acquisition, or am I going to exit through a stock buyout? And besides looking at the unicorn goal of being a $1 billion startup or company, which is being a company valued at more than $100 million worth of revenue annually. And that is more achievable. But the exit strategy for these kind of startups has always been seen to be more to the corporate side. So the big companies in a particular ecosystem buying out the smaller companies. So if we could have like a company in Uganda, maybe Cipla buying out Rocket Health, Cipla valued maybe, let's say, at $2 billion just for argument's sake, and Rocket Health valued at say maybe $50 million or $100 million, then that buyout is much more manageable. But Cipla is a traded company, and this company is a privately held company, which is a lot more believable compared to building castles in the sky. So I think the more Ugandan startups we list, the more Ugandan large businesses we list on the stock market locally, and the more capital we raise for them, gives more opportunity for them to support and acquire or invest in the smaller startups that are probably approaching gazelle stage or already at that stage. Yeah, that's basically.
Geoffrey, thank you. Thank you very much for those comments. I'll ask our panelists. Paul and Robert, I'd like a few comments from you in terms of what regulatory innovations, this is a question from Samuel Sanya, what regulatory innovations are needed to inspire local participation. Paul, I'd also asked you to comment on who is being engaged and how more banks can raise long-term financing through the exchange.
Thank you, Salma. So what we've been doing, we've been working with the Capital Markets Authority and the Ministry of Finance to address a couple of issues. One of those is the tax rates for listed companies. Wilbrod mentioned that the withholding tax is at 20% for short-term denominated bonds, the interest rates. And those are some of the things we have been addressing. We've made proposals in areas that listed companies should pay lower corporation tax so that we can attract companies to the market and differentiate it from the public market. We're also looking at some allowances that are given under the Tax Act that allow companies to recognize their listing costs. I think they're written off over 4 years, but there are a few changes we're looking into. We also want to reduce the withholding tax on both dividends and on dividends from the current 10% for residents to 5%, so that we are aligned to the East African countries, Kenya and Tanzania. And we think that with that, we should be able to become a little more competitive, but also offer that as an incentive for companies to list. We also been speaking to the ministry about what we call public interest companies. This has included banks, and there's been a discussion around insurance companies. That is, we're working hand in hand with the central bank, but also hand in hand with the IRA, Insurance Regulatory Authority, to see how best this can work and which kind of companies would fall into that criteria, and also provide incentives so that these companies can be able to raise capital of the exchange and through the capital markets. In addition, we've been part of a task force that is looking at a 20-year infrastructure bond. I think that is still ongoing, but this is supposed to be differentiated from the 10-year and 15-year bonds, and provide, it should be, well, what we'd call tax-free, but with a lot of incentives and specific to specific projects that the government would be undertaking under infrastructure. Still early days, but a lot has been discussed on what the concept should look like. And that is among the things we've been doing with the ministry to encourage companies. On the other note, we also try and see how to create more awareness and education programs, such that the general public and issuers can actually understand the capital markets and see what products and solutions they're able to utilize at the exchange and through the capital markets. So those are some of the things we've been doing on that. Thank you.
Thank you, Paul. Robert, any comments from your end on the same?
No, sure. I think it's really my last slide, which talks about regulatory reform. And I think in answer to Sunny's question, that banks should be, the tier 1 commercial banks should be required to list. I think that's one reform. I think another one maybe that can happen a bit earlier is there are discussions with the Capital Markets Authority about a segment or an option for companies, because companies may come to the market but not need capital. They could then come to the stock exchange through a listing by introduction. So another reform would be to put that listing by introduction rule through and for CMA to approve it. And that way we would be able to get companies closer to the stock exchange for the time when they were ready to take on capital. I think there was a young entrepreneur was talking about that. It could be from either segmented from very large existing companies all the way to some, let's say, startups, or not quite startups, obviously, but because we do have to always keep risk in mind. But at the same time, I think we should, as a market, not create the barriers. We should look for those innovative ways to get companies into the public space, whether they're raising capital or not. So I think a listing by introduction approval by CMA, that rule, would go a long way to helping us.
Okay, thank you, Robert. Maybe we can also get some insight or a comment from Wilbert and Simon regarding whether we are focusing, the fact that the risk-free rate remains high. That's what's driving the lending rates higher. How can we, or what can be done in managing and mitigating that? Because that plays a key role, even from, as we saw in your presentation, it plays a key role in the lending rates. What are you, or what has been done, and what can be done in that respect? Robert?
Thank you very much. I think the callers really nailed it. High risk-free rates would have a bearing, and I think that was my second slide. I think the most important thing, what can be done from the member bank side and what can be done by the policymakers. Obviously, reducing the high risk-free rates from the policy side is important. And Simon spoke to a combination of things and not just looking at specific individual player categories, but a more holistic view that plays across the entire financial sector, because there are many players. There are pension sector players as well, who are typically providers of long-term finance. For the financial institutions, I think I heard about risk of management capture that has a bearing to the cost-income ratios. I think internally, like I said, we also need to address that, especially by way of digitization, for example, to reduce the transaction costs and bring about cost-income efficiencies, and shared platforms so that we don't duplicate investments and then pass on those benefits. The more we do those, as the policymakers also address their bits and looking at the whole sector and not just individual players, I think we will be closer to the solution. And these things all point to the development, the level of development of the market. Thank you.
Yeah, thank you. Let me, I think, also add my voice. Probably let me also, having, I think, worked in capital markets for a long time, and I think I've also had the opportunity to be a regulator and a market player. On the issue of raising capital, now, you have two things with raising capital. You have a benefit by the issuer, and you have obligations. So clearly, the issuer should have an incentive to raise money because of various reasons, whether it's the cost of money, prestige, or other reasons. But there are also obligations that that issuer must meet. Now, in markets like here in Uganda, sometimes you got to coerce or provide incentives for issuers to come to the market. We have been very strong on requiring telecoms, for example, MTN, to list on the stock exchange because it has become a significant player in the market through market capitalization. So very supportive. Robert talked about banks. We would also like to see, the large banks list on the exchange. Obviously, forcing is always a difficult issue, but coercing is a good thing. I think we'll start with saying maybe all those banks which have a government business should list, otherwise you don't get the business. So that conversation is taking place. So it's always though about benefits, because when you're in the private sector, you want to see the benefits and obligations. Then second, let me go to this point of rates. Now, the issue of lending rates is an issue which has a combination of factors. You've got the official regulator, and I'm calling it official because there are certain jurisdictions where the CBR has absolutely no bearing on lending rates. It is an official rate. So when I'm in the investment banking industry, actually, I have a computer with my own CBR, and I compare it to the official CBR and other rates in the system, in the financial system. So when the central bank comes up quarterly with the CBR, that is its official rate. That is what it's saying. That it's looking at inflation, it's looking at inflation expectations, it's looking at the economic system. So when you're a market player, on the other side, you have your own business model. You have your own cost of funding. And you have other rates that signal your cost of lending to the market. And of course, you have competition. And all these factors play into the lending rates, whether it's the repo rates, whether it's the treasury bill rates. And as a market player, because you have investors and shareholders, you must ensure that your business is a going concern. So you're not going to lend at costs which are below your funding costs. However, I spoke about credit rating. And a very important issue here of credit rating is that if you have a good score, I should not be able to go to a commercial bank and get a consumer loan of 28% or 25%. I think that is going to solve that issue. I see a problem there where certain consumers, I don't know whether it's because of financial literacy or credit risk, are subjected to very high rates of borrowing. So again, it comes back to the question on subjectivity. What is high? What is low? What is the source? Because you have different sources. A money lender will give you 10% per month. Commercial bank will give you 28% a year. So again, it's an issue of the appropriate sources and the appropriate capital and the diversification of capital. So I think the issue of lending rates is an issue of structural issues that we have to resolve, whether it is credit rating, scoring, infrastructure, quick justice, and the official CBR treasury bill rate. So all those factors play into the lending rate, including the capitalization of banks. And one question I ask is, why would a person who has a bank which gives him a higher borrowing rate not change his account and go to another bigger bank which gives him a lower rate? So there are all these issues which come into play, and I think the comments that have been made are quite relevant.
Simon, thank you very much. I'd like to give Mariam a bit of room to speak on securitization of loans and other bank products, and whether that could be one of the solutions that we could look into to lower credit risk.
Thank you so much, Salma. Speaking directly to the issue of securitization, I think we see that we have already started deliberations with the reconstruction company in terms of a set of loans that perhaps would require patient capital. So the reconstruction company is already discussing the possibility to offload, for banks to offload that particular portfolio from their balance sheets, and again speaks to patient capital. So it is something that is happening. It is probably something that can in future be considered for the public markets, Securities Exchange. I believe it does increase the the partnership that we have been speaking to. So it also, in terms of partnership, will probably allow for analysis to be, joint analysis to be made both by the exchange as well as either the reconstruction company and the banks. So it gives an entire view of a particular customer from both fronts. Thank you.
Thank you, Mariam. In the interest of time, Tim, this is just a Kickstarter to our conversation. Please feel free to reach out to us at the exchange and to further enhance and see ways that we can grow the market, increase financing options, especially to the banks, and to see to ensure that will help lower their risk or the rate at which they lend funds to you. I'd like to just give a minute to each and every one of our panelists to just give closing remarks and bring this to a close. We'll start in the order that the presentations were made. Mariam, we'll start with you. Any closing remarks?
Thank you, Salma. I think my closing remarks are really around the need to ensure that topics of discussion as this one continue to happen, but most especially that they are backed with data available to address the issue. Speaking to high lending rates today, I think most of the panelists have spoken to other drivers beyond only cost of funding that speak into the lending rates for the bank. So perhaps it is important that all players are aware of what these are and perhaps strategies that can be put in place to ensure that it is a wholesome solution that addresses that rate. So there's a lot of CFA Research Foundation information that is available that can aid such discussions. And I call upon stakeholders to review such information in decision making. Thank you so much.
Wilbert?
Thank you, Salma. Thank you very much for putting this discussion in place. As you know, the pressure is across the industry, the banking industry, the price of lending, including at the highest of levels. So any opportunity to share information of what goes into loan pricing and some of the key issues to be dealt with are very, very important. And that's why we're quite keen on this particular discussion. I think it brings out 2 or 3 things. There is work cut out for all the parties. And the message, again, to re-echo Simon, that if we work together and look at it from a holistic and more longer-term view than looking at the question of pricing from a very narrow short-term view, we have a better chance of nailing what the issue is. So thank you very much once again for the discussions.
Thank you, Wilbert. Simon?
Let me echo again the panelists' sentiment. Thank you very much for organizing this. I think it's been very insightful. It's a conversation which we need to continue. I would like, I think, to end again by saying that we need to work together. This is a vision of a coordinated and holistic ecosystem. The business is about mobilizing capital. Capital comes from different sources. It's short, it's medium, it's long term. So we must have as many sources of capital as possible, whether it is risk capital, whether it is venture capital, whether it's private equity, whether it's capital markets, whether it's commercial banking. So this is the issue of really a diverse source of mobilizing capital so that we can again deploy it short, medium, and long term. We must increase and improve our monitoring of this capital, the systems. We must use infrastructure. We must use technology. We must lower transaction costs. So I think if we can work together again with the regulators and with the players, I think we can deliver the vision of a more competitive and progressive financial sector that is anchored on inclusiveness, means all of us have to get involved, the whole population, and stability. So again, thank you once again.
Thank you, Simon. Robert?
Sure, thanks, Salma. Again, thank you to another round of thank yous to the USC and the sponsors for today. One thing about continuity is that the stock exchange has seen some challenges due to COVID, as Paul reckoned, the reduction in turnover. But from Crested Capital side, I think our investment banking section has never been this busy. And it echoes a little bit about what the other panelists are saying in terms of professionals. We need professionals to be working on helping companies. The companies that are in distress, they're good companies, but they need help out there. So I think all of us have a role to play. From the side of the capital markets, and it's not, the capital markets are not just the stock exchange, right? So someone who takes and borrows a little bit today, borrows a little bigger tomorrow, later can get on the stock exchange with that track record. So it also has to be a pipeline of companies that are getting improvement. I think, Simon, you spoke to quality of many things in these companies, but we're all there, and we're all here to work on helping companies get to the market. At the same time, that helps the banks, because the banks don't want the non-performance. The banks will be struggling. KCB, the example one of the speakers gave, increased their NPLs 40%, and that's just one bank. So we're expecting continued distress from companies, and I think that this forum is a good one for looking at ways to solve it. So thanks again to the USC. We look for the next webinar. Look forward to it.
Thank you, Robert. Paul, closing remarks?
Yes, once again, also to thank the panelists and all the attendees for participating in this webinar. I think this has been a very interesting subject of discussion. We look forward to implementing or looking at the views that have been shared and seeing how best to utilize them in terms of moving forward. But also to state that as the exchange, we've committed to having more of these, interacting with different sectors, different associations, to actually create more awareness of the capital markets and the role we play. So this is just a first, and we look forward to having all of you at the next one that we'll share the details soon. And encourage that these discussions continue outside this panel, this webinar, and ensure that we get solutions for our companies and the economy, so that companies can actually raise money and the economy grows. So once again, thank you very much for attending and joining us today, and we look forward to seeing you soon. Thank you.
Okay, thank you to each and every one of our panelists. Thank you to the attendees. Let's continue to engage and interact with each other. If there are any, or if your question has not been satisfactorily answered, please feel free to reach out to us via email. You can email info@use.or.ug. We'll pick up those inquiries and route them to the panelists so that you can have your insights and your questions answered. Thank you very much. I'd like to close it here. Thank you. Have a good rest of the day.
Thank you.
Thanks, Omar.
Thank you.